The latest budget just blew up everything we thought we knew about inheritance tax planning. If you've been relying on things like agricultural property and business relief to protect your assets, or thought your pensions were safely out of reach, think again. Suddenly, all the strategies people counted on to keep wealth in the family are being pulled right into the taxman's grasp. So, what exactly happened? And what does it mean for your plans? Let's dive in. Hi, my name's Carl, and if you're new here, welcome to the channel. I'm a practicing regulated financial advisor and also an investor who helps run a fund management company. Now in these videos, these are not regulated and are not meant to provide advice, just purely guidance and things for you to think about and to maybe do some of your own research on. I generally cover personal finance topics, which involve things like investments, property, taxation, pensions, ISAs, and protecting your wealth down the generations. In a move that's bound to hit more families, the budget has frozen the nil rate band and the residence nil rate band, the main allowances whereby no inheritance tax is paid, until at least April 2030. The nil rate band, set at £325,000, has remained unchanged since 2009, and the residence nil rate band, introduced in 2017, currently sits at £175,000. But freezing these thresholds in a time of rising asset values effectively drags more people into paying inheritance tax. With inflation pushing up the value of homes and investments, many estates that would have previously been under the threshold will now be pushed into taxable territory. For example, a family home worth $300,000 in 2009 would have avoided inheritance tax if this was the only asset. However, since 2009, house prices have increased by around 84%. This means the same family home could now be worth $553,000, meaning a potential £91,000 inheritance tax bill needing to be paid by their loved ones. While the family may have initially fallen within the allowances, the freeze means they now face a sizable tax bill, often forcing their heirs to sell assets just to cover the tax burden. So the recent budget has not only tightened eligibility for agricultural property relief, but has also introduced a cap on the relief amount, which previously allowed up to 100% inheritance tax exemption on qualifying farmland and buildings. But from April 2026, agricultural property relief is capped at £1 million, with any value beyond this facing a new 20% inheritance tax rate. The adjustment adds a significant tax burden to family farms that were often able to pass down large areas of land without incurring tax. Previously, a farm valued at £1.5 million, the entire value might have qualified for agricultural property relief if the property met certain criteria, shielding it completely from inheritance tax. But now from April 2026, only the first £1 million qualifies for 100% relief, while the remaining $500,000 will be subject to the new 20% inheritance tax rate. This change creates a £100,000 tax liability on the additional value. Now, for many farming families, this added cost might force them to sell off a proportion of the farm to cover the tax burden, which potentially jeopardises the continuity of generational farming operations. Now, there are also some big changes to business relief and the impact that it will have on AIM stocks. Now, business relief has long been an attractive planning tool for those investing in shares of small businesses or companies listed on the alternative investment market. Historically, holdings in AIM-listed companies qualified up to 100% business relief if they were held for at least 2 years, which allowed investors to shield these assets from inheritance tax while investing in high-growth, innovative companies. But from April 2026, the budget has now restricted business relief for AIM stocks, specifying that only actively managed businesses, not passive investments in companies, will qualify. A 50% relief will apply in all circumstances on AIM shares, setting the effective tax rate at 20%. Now, this change directly impacts investors holding AIM stocks as a strategy to reduce their taxable estate. For example, an investor who has built up a £500,000 portfolio of AIM stocks would have previously expected that the investment would be free from inheritance tax after 2 years. But with these new restrictions from April 2026, this investment could face a 20% inheritance tax charge on death, meaning a potential bill of £200,000. The good news is that you still have just under 2 years before these changes come into force. For those who are currently holding AIM stocks and have held them for at least 2 years, these could be gifted to your beneficiaries or to a discretionary trust now before the changes take place and would still be free of inheritance tax. Now, moving on to pensions, the latest budget announcement has shaken up the world of inheritance tax planning by proposing that pensions will soon be included in the inheritance tax net. So for years, pensions have been one of the most effective tools for reducing inheritance tax liabilities, allowing people to pass on significant wealth to their beneficiaries without incurring a tax charge. As pensions are often a person's second largest asset after their home, this shift will have a dramatic impact on the inheritance landscape, potentially driving up inheritance tax bills for families across the UK. Now, under the new proposals set to take effect in April 2027, the value of a pension pot will be counted towards the estate for inheritance tax purposes upon death. Previously, pensions were generally exempt from inheritance tax, giving them a unique advantage in estate planning. Many people have used their pension pots as a tax-efficient way to pass wealth to loved ones, often drawing on other assets first in retirement to preserve pensions for inheritance. This change will significantly increase the tax burden on beneficiaries who may now face a 40% inheritance charge on their inherited pension assets. So for example, a person with a £1 million pension pot who had previously anticipated this asset would pass free of inheritance tax may now leave their beneficiaries facing an additional £400,000 tax liability. Adding to the complexity is the fact that beneficiaries are already subject to tax on inherited pension income if the pension holder dies after the age of 75. Currently, beneficiaries of a pension from someone who dies post age 75 must pay income tax on any withdrawals at their marginal tax rate. The proposed changes will mean that in addition to income tax, beneficiaries could also face a hefty inheritance tax bill on the same pension pot. This could lead to a situation where, depending on the size of the pension and the beneficiary's income tax rate, a significant portion of the inheritance is lost to combined inheritance tax and income tax charges, which could mean an effective tax rate of 67% on pension funds. The fact the government are waiting until April 2027 to introduce this means it is going to be highly complex to sort out, so it's not definite the proposed rules will stay exactly as planned. This gives us time to plan ahead, but moving pensions away from inheritance tax will be tricky, as you can't give money away without already paying income tax on it first. So what about planning ahead to minimise an inheritance tax? With these changes on the horizon, the best path to avoiding a substantial inheritance tax bill may now involve a combination of strategic gifting and insurance policies. By gifting assets either directly or through trusts, families can start moving wealth out of the estate over time, reducing what's subject to inheritance tax. Trusts, in particular, allow for more control over when and how beneficiaries receive assets, while providing some protection against inheritance tax if properly structured. Insurance policies can also play a valuable role, especially when it comes to covering any remaining inheritance tax liabilities. Many people now consider setting up a life insurance policy placed in a trust specifically for this purpose, ensuring that loved ones have the funds to cover the inheritance tax bill without needing to liquidate other assets. You need to think of an insurance policy not as an insurance policy, but as a guaranteed investment savings vehicle. So fortunately, we do have a 2 to 3 year window before some of these changes come into effect, which means it's crucial that we start planning now. Thoughtful consideration will be needed when it comes to which assets to draw down on and which to preserve for inheritance, as well as determine what should be gifted during one's lifetime. By taking early strategic steps, families can protect as much of their wealth as possible, even as the tax landscape becomes more challenging. I hope you found this video useful. If you have found some value, if you've got any questions or comments you'd like to make, please do leave a comment in the box below the video. I do look at all of them and try and answer as many questions as I can. And also, if you are new to the channel and you haven't already, please do subscribe to the channel so you don't miss any upcoming videos. And if you prefer reading material, you can also sign up and register for my Substack email that comes out at least weekly with some more thoughts on personal finance. The Substack is entitled Money Matters. Until next time, take care.